Governor, you seem to have been taken by surprise by the sheer strength and speed of the recovery.
First I would say we welcome the strength of the recovery. We have inflation coming down. The economy is creating 60,000 jobs a month. Growth is as strong as it's been in 6 years, since 2008, since before the crisis. So all of that's to be welcomed. When I first arrived here, my colleagues and I at the bank thought the recovery was going to be stronger than others thought it was. And we also thought inflation was going to be weaker, softer, moving more towards that important 2% target than others thought. What's happened is it's turned out to be, at this moment, a little stronger than we had expected, and inflation, in quite a welcome sense, is softer. So both of those are good things.
And yet, in 3 months, you've actually had to kind of change your game plan a bit, because you talked originally about simply the 7% unemployment level as being a benchmark against which you then think about raising interest rates. Now there's a lot of add-on.
No, we haven't changed. The important thing, John, is we haven't changed our game plan at all. What we said to your listeners, people across this country, business people, is that the Bank of England is not even going to begin to think about raising interest rates until we see unemployment come down to a 7% level. Now today, unemployment rate is 7.6%. So we want to see real people in real jobs and that unemployment rate moving to that level.
But you've moved your projection forward. You think it could happen. There's a 2 in 5 chance of it happening next year, a 3 in 5 chance the year after, which is sooner than either of the projection you put forward.
And that's a product of the fact that the economy, the recovery has taken hold. The economy has picked up. But the important thing is, what will we do at that point? What will we do as the Bank of England with interest rates at that point? And we're not automatically going to change interest rates at that point. We're going to take stock of where the economy is, how much spare capacity there is in the economy, how many people are out there looking for a job, or how many people are in a job who want to work more, how much spare capacity is there in our businesses to produce more with the machinery that they have. And taking that assessment, then we'll decide what to do with interest rates, because the important thing is we're going to learn a lot from this point until that point.
Okay.
As the economy grows, we'll find out how truly productive this economy is.
But what sort of a recovery is this? Is it frothy? Is it kind of financial services? Is it kind of stuff that's dicey? Or is it real, solid manufacturing, the stuff that builds an economy long term?
Well, there's two things. We need that type of recovery, and we're helping to try to secure it by providing this guidance on interest rates. Because what's happened in this recovery, about 6 months ago, the British people started to decide that the world was not about to end because of problems outside our shores, problems in Europe, problems in the American financial system, what have you. The world's not going to come to an end. And they started to reduce their savings from extremely high levels, precautionary savings levels, to more normal levels of savings. So we're getting a one-time boost from that adjustment. At the same time that that was happening, the housing market started to recover from, quite frankly, depressed levels relative to recent history. So we have those two factors. The question is, how do we sustain that? Well, we sustain that in a couple of ways. One, we fix the financial system, and my predecessor, Governor King, Lord King, started that process. We're going to finish the job. Secondly, we provide the stimulus the economy needs for the length of time that the economy needs until the conditions are in place where we have that sustainable recovery that's based on real jobs in real industries.
But then if the recovery is real and is really underway, as you say,
yes,
then why do you need emergency levels of interest rates? I mean, this is an emergency level.
Without question, these are interest rates are at a historic low. Think about the headwinds that are blowing into this recovery, that are holding back the strength of the recovery. Our major trading partner, the European Union, is still stagnating. It's no longer shrinking rapidly, but it's still stagnating and probably will for some time. We expect 1% type growth for the European Union. The UK economy is growing at about 3% right now. That's one aspect. Secondly, those banks, there's been a lot of progress on the banks, but they still need to build more capital. They still need to repair. They still need to fix some things. So they're not, I speak to a lot of small, medium-sized enterprises, and they're still not fully satisfied with their access to capital.
But we could surely ease austerity, couldn't we?
And thirdly, well, that's a judgment that the government has to make. We take that as given and we set policy accordingly. But the other thing I'll say, John, is that the British people are looking at their own balance sheets, and that's why they were saving more money out of every paycheck than they did prior to the crisis. And that process of repair and that unwillingness, correct unwillingness, to return to a sort of debt-fueled consumption is something that also will moderate the pace of this recovery. For all those reasons, it is appropriate for the Bank of England to provide that stimulus and to provide people and entrepreneurs across this country with a degree of confidence about the conditions that it would be necessary for us to start to take that off the table. We summarize that in the 7% unemployment rate, but really we're talking about, when we get to that point, looking at the conditions in the economy, how much slack is there in the economy, and how much momentum does the economy have, and then we'll take stock and decide what to do.
We're talking on quite a rare day, because we haven't seen a governor bounce into action like this, talking in the way that you've been talking for quite some time. And therefore, one wonders what this really means to the man and woman on the street. They are not feeling this. I don't think they'll find it easy to identify with what you're saying. Well, they're going to say, we're not experiencing this growth. Our wages, if anything, are going down.
Well, it's a very important point. I think not everybody across the country is feeling this, without question. There's still 1 million more people out of work than were in work prior to the crisis.
But even those in work.
But you're right. But what is happening, I don't think we should downplay it. What is happening is 60,000 jobs per month. New jobs are being created, most of those in the private sector, most of those full-time. That's real work, real people. So let's acknowledge that. The second thing is, you're absolutely right. Real wages are not picking up. They haven't been for a number of years.
When will they?
And the expectation, and what's required for them to pick up, I think, is the way I would phrase it.
They'll want to know when.
And what's required is that business starts to have as much confidence in the recovery that's necessary for them to start investing, and that's going to help boost real wages. So in the second half of our forecast, middle of 2014 through to the end of 2016, embedded in that forecast that we just released today is that you start to see real wage gains. In order to get that, though, we need businesses to have the confidence that this recovery is going to be durable, which is why we're doing what we're doing with the banks and what we're doing with monetary policy.
Well, this is your sort of first television interview since you were appointed. And of course, one question that abides is, are you your own man? After all, George Osborne scoured the world for you and even changed the employment parameters in order to make it attractive for you to come. Are you?
Of course, absolutely. I mean,
but
I've been an independent central bank. Well, there's two things. One is that the great advantage of the structure that's been put in place for the Bank of England is the governor is absolutely independent. And in fact, the other members of the Monetary Policy Committee, which sets interest rates, and the Financial Policy Committee, which sets financial policy, we're all independent. I have one term. I have one term. I've been appointed by
nothing to lose.
I have my reputation to lose, and I will make sure I will do everything I can to make the series of right decisions.
But I mean, raise interest rates just before a general election, if they had to be done, would you really do it?
Well, absolutely. I had the experience of being in a similar position during the crisis. And in Canada, we had the opposite issue, which was, should we cut interest rates in an emergency fashion in the teeth of the free fall after Lehman? Now, that wasn't as acknowledged around the world that that's what was actually happening. We decided that was the right thing to do, because it was the right thing to do for the Canadian economy. It was in the middle of an election campaign, and we did it. Okay, but in these jobs, and I have the experience of being in these jobs, you just have to do the right thing with an eye on the medium term. That's the horizon for central bank policy.
But you've got another much more tricky judgment to make in some ways, and that's help to buy. It's hard to imagine the governor of the Bank of England is really enthusiastic for such a scheme, because after all, you are looking at a subsidy of 95% for people's mortgages. That's what got us into trouble the last time. Why do you want to be involved in that now?
Well, what we have to do when we look at the housing market is we have to identify whether or not there's going to be risks that arise in the housing market. Are people going to end up borrowing too much? Is it going to be a risk to the banks, and therefore a risk to the entire
isn't 90%, into the risk
and a risk to the entire economy? And we have to look across a range of issues, whether it's the structure of help to buy or any other government program, whether it's how much capital a bank holds against a mortgage, whether it's how they conduct the tests, whether individuals can afford to pay those mortgages back. All of those aspects we can have influence on. Some of them we can control directly as the Bank of England. Others, we have a responsibility to stand up and say, if it can improve the financial stability of the economy, we have a responsibility to stand up and say, make this change. In our judgment, make this change.
Even though that is a golden acorn of the government's policy, and you could be having to do it less than 6 months before a general election.
We will do what's right. We have very clear mandates at the Bank of England. We have a responsibility to deliver that 2% inflation target so people can ultimately see real wage growth. We have a responsibility to make sure the financial system is resilient, and we will take the steps necessary. In some cases, if I may, John, some cases we have direct responsibility. We can instantly change things. In others, we have to make recommendations, but we do those in public.
You mentioned the Eurozone just now. Washington last week was pointing the finger at Germany, saying the very fact that Germany had these huge surpluses from its massive export market. Yeah. And Brussels is doing the same thing today. Do you see Germany as the problem?
I'd see Germany as part of the solution to sustainable recovery in Europe. I mean, there are German exports.
Well, to be part of the solution, you can be part of the problem.
Well, there are German exports and there are German exports. German exports outside the Eurozone actually have a supply chain. In most cases, you think about German auto exports, actually more than 3/4 of the components of German auto exports come from other areas of the European Union, including in some cases here. But there is a question about the strength of domestic demand, and I don't mean fiscal policy in Germany, I mean more broadly domestic demand, and there's a series of structural measures that the German authorities are aware of that they could take, which would help raise the growth in Europe, which would be good for Europe and it would be good for us.
You used one of your early speeches to bolster the view that the city needs to grow. You want to see the city grow. You're an enthusiast for the city, and you've told the city that you're an enthusiast for the city. And you're talking this up at a moment when still scandal stalks the city, not least in the foreign exchange outrage which has been going on, in which at least 3 British banks appear to be involved. Is this the right moment to be saying grow the city? Isn't it time to say tame the city?
There are two things. I'll come to taming the city in a moment. We're not the Bank of England, and
you're a great one for two things, Governor.
Well, you asked
2 things.
You embed multiple. I'm choosing 2 of the many things I could pick from that question. But the first thing, we're not at the Bank of England. We're not cheerleaders for the city. Our job is to make the city safe, effectively, and the financial system safe, and then it will find its own size. And the point I was making in the speech is that London is the global financial center, and finance as a proportion of the global economy is going to grow. Not because it's going to grow in the advanced economies, but because it's going to grow in the emerging economies. And London's traditional role is to be in the center of those flows. Now, if London follows that route, as it has in the past 4 centuries, then it's going to grow relative to the economy. If. Our job is to make it safe. There's 2 aspects of that. First, make it fair. Fairness means that if you make a mistake in the city, you pay the consequences. If you make a business mistake and you're a big bank, you fail, just like you would if you were a small corner shop anywhere across this country, a farmer, whatever. Make
is
a mistake,
this part of the taming?
And this is part of the taming. Yeah, I'm on my second. I'm sorry, I should have signaled. And so there's a series of reforms we're doing so that end too big to fail. The second part of the taming and part of the fairness is the integrity of these markets. These have to have the most integrity of any markets. We have to change the structure of these markets, and we're working on that. And we have to root out corruption in these markets where it's found. And we are very concerned about the allegations in the FX market. We are supporting the authorities, the FCA and others in their investigations, and we will do so, and we collectively, it's not our primary responsibility, but we'll do everything we can to root this out. I'll say the last thing on it, if I'm allowed 3, which is ultimately these issues of integrity. They're issues of culture within these organizations, and they are the responsibility of the senior management and the boards of these organizations to set the right tone from the top all the way down through the organization so that it can be delivered.
Does it set the right tone to be saying to the Chinese, come in, do business here, set up banks, and actually the regulation you'll be subjected to will be actually lighter than that which we've applied to banks which have already gone off the rails?
That would not be the right thing to say, but we certainly haven't said it.
Well, the implication is very strong.
No, absolutely not. What we have done is we have changed our policy for foreign branches in the UK, and we have put an emphasis on this fairness point, what is crucial is the ability to resolve the institution if it makes a mistake. And so we need an understanding with those foreign authorities. We might come to that understanding with the Chinese authorities, and it's logical that the Chinese would be here. But the second thing that we've done is we have restricted this activity to what's called wholesale activity. So it's not a retail activity. You and I aren't going to have accounts at these banks. It's going to be city-like activity if it indeed occurs. But these are the same rules for everybody. The Chinese aspect is a product of the fact that the Chinese, this is the second largest economy in the world. It's one of those emerging market financial sectors that is growing quite rapidly. London is the global financial center, and it's natural that some of this activity would gravitate to London. But it's got to be done in the right way.
By your own words, you are a foreigner, and you already look quite comfortable in the job. And I'm just wondering whether, having spent 10 years in this country earlier on in life, especially time at Oxford, gives you a kind of insight into the structures of this country in terms of the establishment, the public school system, the class system, which John Major, our former Prime Minister, has described as one of the things possibly even holding the country back. Do you understand the world you're in? Do you resent it, find it difficult, or find it very easy?
I think, as a foreigner, you have a different perspective, and maybe an objective. I would hope an objective perspective. I think I do understand. I know what I don't know in this country, and that's quite a bit. But it's necessary. I have the friends and family extended relations I have in this country are. Extend across the social spectrum.
And I gather across the Irish Sea.
And across the Irish Sea,
you're an
yes.
Irish citizen.
I am an Irish citizen. I'm a Canadian citizen.
You're also
Irish citizen,
a British
yes.
subject, so
Yes.
British citizenship can't be far away.
I will to take up my right to British citizenship. There's a residency requirement.
Oh, you are interested in doing it?
I made that commitment to the Prime Minister. The residency requirement actually extends to about the end of my term, as it turns out, despite the fact that I have been married to my British wife for 18 years. So,
Governor, thank you very much indeed for talking to us.
a pleasure, John. Thank you.